Yield curve risk. Exploring the impact of yield curve movements. Agenda overview. Introduction to yield curves. Yield curve risk overview. Parallel yield curve shifts. Non-parallel yield curve shifts. Managing yield curve risk. Definition and significance of yield curves. Understanding yield curves. A yield curve visually represents interest rates across different maturities of debt instruments, helping investors analyze trends. Investment decision making. Yield curves are vital for investors, aiding in making informed decisions about investments and borrowed funds based on interest rates. Interest rate environment. The shape of the yield curve reflects the current interest rate environment, indicating economic conditions and expectations for growth. Types of yield curves: normal, inverted, flat. Normal yield curve. A normal yield curve slopes upward, indicating the longer maturities have higher interest rates, reflecting expected economic growth. Inverted yield curve. An inverted yield curve slopes downward, suggesting potential economic downturns as long-term interest rates fall below short-term rates. Flat yield curve. Flat yield curve occurs when short-term and long-term interest rates are similar, indicating market uncertainty and mixed economic signals. Factors influencing yield curves. Inflation expectations. Inflation expectations significantly impact yield curves. When investors expect higher inflation, they demand higher yields on bonds. Economic growth. Economic growth influences yield curves as stronger growth typically leads to higher yields due to increased demand for borrowing. Central bank policies. Central bank policies, including interest rates decisions, play a critical role in shaping yield curves and influencing market expectations. Market demand for bonds. Market demand for bonds affects yield curves. Higher demand typically leads to low yields and vice versa. Definition of yield curve risk. Bond price variability. Yield curve risk involves fluctuations in bond prices that occur due to changes in interest rates along the yield curve. Interest rate sensitivity. This risk demonstrates how sensitive investments are to shifts in interest rate structures, impacting investor returns. Importance of managing yield curve risk, portfolio stability. Managing yield curve risk is essential to ensure the stability of investment portfolios in changing market conditions. Impact of yield curve shifts. Ignoring potential shifts in the yield curve can lead to significant losses and affect the valuation of fixed income securities. Fixed income securities. Proper management of yield curve risk protects investors from adverse market movements that can devalue fixed income securities. Impact of financial instruments and portfolios. Yield curve risk. Yield curve risk affects various financial instruments, especially bonds, making them vulnerable to interest rate changes. Bonds and interest rates. Bonds are particularly sensitive to fluctuations in interest rates, impacting their valuation in financial markets. Portfolio value protection. Effective risk management strategies are essential for protecting portfolio value against market volatility caused by yield curve changes. Parallel yield curve shifts, uniform interest rates changes. Parallel yield curve shifts represent a simultaneous increase or decrease in interest rates across all maturities, affecting the entire yield curve. Market interest rate changes. These shifts reflect changes in overall market interest rates, indicating broader economic trends rather than movements in specific maturities. Causes and examples of parallel shifts. Monetary policy changes. Changes in monetary policy, like interest rate adjustments by central banks, can lead to parallel shifts in financial curves. Economic forecasts. Economic forecasts that predict changes in the economy can also cause parallel shifts in the yield curve. Yield curve shifts. The central bank increase in interest rates typically results in a parallel upward shift in the yield curve, indicating higher yields. Impact on bond pricing and duration, effect of interest rate shifts. Parallel shifts in interest rates significantly impact bond prices. An upward shift leads to decreased bond prices. Understanding duration. Duration is a crucial measure that indicates a bond's sensitivity to interest rate changes, aiding in risk assessment. Risk assessment in bonds. Calculating duration is essential for evaluating the risk associated with bond investments in changing interest rate environments. Non-parallel yield curve shifts, independent rate changes. Non-parallel yield curve shifts indicates that interest rates for different maturities can change independently of one another. Market sentiments. These shifts in the yield curve can reflect varying market sentiments and perceptions about the economy over different time horizons. Types of non-parallel shifts. Twists, butterfly shifts. Understanding twists. Twists occur when short-term and long-term interest rates move in opposite directions, impacting yield curves significantly. Butterfly shifts explained. Butterfly shifts involve changes in interest rates that are concentrated around specific maturities, affecting pricing models. Importance in pricing models. Understanding these non-parallel shifts is crucial for developing accurate pricing models in financial markets. Impact on different maturities and bond pricing variability. Non-parallel shifts in interest rates creates different pricing impacts on bonds with varying maturities, affecting their market value. Duration sensitivity. Bonds with shorter and longer durations respond differently to interest rate changes, influencing investment decisions. Risk management strategies. Effective risk management strategies must be tailored to account for the varying impacts on bonds based on their maturities. Strategies for mitigating yield curve risk. Diversifying bond holdings. Diversification within bond holdings can reduce risk associated with yield curve changes, offering a balanced investment approach. Adjusting portfolio duration. Adjusting the portfolio duration allows investors to better manage sensitivity to interest rate changes, minimizing potential losses. Utilizing derivatives. Utilizing derivatives can provide effective tools for hedging against yield curve risks, enhancing overall portfolio stability. Hedging techniques, duration matching, interest rate swaps. Duration matching. Duration matching is a strategy that aligns the duration of assets with liabilities to minimize interest rate risk. Interest rate swaps. Interest rate swaps are contracts that exchange cash flows to manage exposure to interest rate fluctuations effectively. Yield curve risk protection. These hedging techniques are crucial for protecting investments from potential losses due to yield curve changes. Role of financial derivatives in risk management. Yield curve risk management. Financial derivatives are essential in managing yield curve risk, helping investors navigate interest rate fluctuations. Hedging tools, options, futures, and swaps serve as crucial hedging tools, allowing investors to protect against potential losses. Interest rate changes. Derivatives help mitigate risks associated with interest rate changes, ensuring financial stability for investors. Conclusion. Importance of yield curve risk. Understanding yield curve risk is essential for effective financial management and investment strategy formulation. Parallel and non-parallel shifts. Recognizing the differences between parallel and non-parallel shifts in yield curves helps investors strategize appropriately. Portfolio protection strategies. Implementing strategies to protect portfolios from yield curve changes is crucial for optimizing returns. Thank you.